Karissa McDonough joins us right now to talk more about all the factors from tariffs to inflation data that will go into any decision the Fed makes on interest rates. She is fixed income strategist with People's United Advisors. Karissa, thanks for joining us tonight.
Thanks very much for having me.
And for the record, you are forecasting maybe a couple of rate cuts, maybe July and September. How much of that is contingent on Chinese tariffs remaining in place?
I think a good portion of that, in fact, we were really only looking for one hike before September, but the continuation of tariffs make us think that we really need to think about the Fed stepping in here and forcing the hand of, whether it's the market or just getting ahead of it. So, yeah, those two hikes for sure by September, and that's where we're standing today.
And how important is each individual data point to the Fed at this point, and also the conditions of the corporate credit market as well? Because the data has been somewhat mixed, which is complicating things for the Fed.
That's right. Well, the Fed needs to build its case in terms of making these cuts. Kind of their shadow third mandate behind inflation and employment has been financial market stability. So they do pay attention to a degree to what the stock market is reacting to, but we haven't seen that type of reaction from the credit markets. So they're really concerned about what each data point is showing them, and the fact that inflation continues to not be at their target is a concern. And it has been the cause of rate cuts in past cut cycles, and we believe that that's going to be the case this time around as well.
Let me pursue again on the Chinese tariffs. Let's assume that we get a deal in the near term, or let's assume we get a rate cut of some kind, and then suddenly the tariffs go away. Does that mean the Fed has to raise that rate that it just cut?
No, that's an excellent question. I'd go back to comments that were made earlier in the show. We've really only had monetary policy for the past 10 years. It's been a struggle to have fiscal policy here driving the economy. So that's still where we are today. I mean, tariffs were potentially a drag or a deflationary measure on the global economy, and just to have those removed doesn't mean that all of a sudden we're in a global reflationary environment. So I think a Fed cut coupled with the tariffs potentially being taken away, those would be positive, but not inflationary to the degree that the Fed would be concerned.
All right. Karissa McDonough with People's United Advisors. Again, thanks for joining us tonight.
Thanks so much.